Hi, I'm Marcus Chen, earnings analyst at Alphatica. Today, we're answering the question everyone is asking after Netflix dropped 10.9% on earnings. Is Netflix at a top? We ran 3 quantitative tests against years of financial data. Here's what we found. First, the numbers from the quarter. Revenue grew 13.3% year over year, but missed by 0.2%. Adjusted EPS beat by a penny. Operating margin declined 70 basis points year over year. Both cash flow from operations and free cash flow missed expectations. Q3 was guided below on revenue, operating income, and EPS. Then the disclosure change. Management announced it will report engagement metrics once per year instead of twice starting in 2027. When a company reduces the frequency of a metric that investors are scrutinizing, the optics are negative regardless of the reason. The stock sold off 10.9% in a single session. Now the 3 tests. Test 1, growth rate deceleration. We measured year-over-year revenue growth for every quarter going back to 2023. The trend is clear. Growth peaked at 17.8% in Q3 2025. It has decelerated to 15.5%, to 13.8%, to 13.0% in the current quarter. Q3 guidance implies another 100 basis points of deceleration excluding currency. The street expects growth to settle in the low double digits through 2028 at 11 to 12%. The growth rate is compressing, but it is not collapsing. Netflix is still adding $6 billion in annual revenue. 13% growth on a $51 billion revenue base is not a broken business. It is a maturing one. Test 1 says, warning, not confirmed. Test 2. Estimate revision direction. We tracked how consensus estimates have moved over the last 90 days across 8 measures. Q3 EPS, Q3 revenue, Q4 EPS, Q4 revenue, full year 2026 EPS, full year 2026 revenue, full year 2027 EPS, and full year 2027 revenue. 7 of 8 are flat, within 0.5% of where they were 90 days ago. Only FY 2027 EPS declined and by less than 1%. The street is not cutting Netflix. The Q3 EPS estimate was trimmed by 1 penny. Q3 revenue cut by 0.5%. These are haircuts, not demolitions. Test 2 says neutral. Estimates are stable. Test 3. This is the one that matters. We tracked the consensus price target mean and standard deviation over the last 6 months. The pattern over the last 17 days is the clearest topping signal in our framework. Dow. 8 consecutive readings where the mean target fell while the standard deviation rose. Mean dropped from $115.62 to $100.90. Standard deviation nearly doubled from $10.56 to $17.22. Translate that. The street is lowering where they think the stock should trade while simultaneously disagreeing more about what the right price is. Some analysts cut to $70, others held at $120. The spread is the widest since January. UBS cut their target to $115 from $130. Pivotal Research cut to $70 from $96. The average target dropped 5.9% to $106.17 on a single earnings print. When 55 analysts moved the consensus by 6% in one day, the prior valuation regime is over. Test 3 says bearish. The topping pattern is active. But here is the other side. The valuation reset has already been severe. Netflix now trades at 20 times forward earnings. The 5-year average is 32 times. The 5-year low is 12 times. At 20 times, the premium has already been cut by 40% from the average. 73% of 55 analysts rate it buy. 0 have a sell, not 1. The consensus rating of 1.34 is solidly in buy territory. They are cutting targets but not ratings. That means they believe in the business at a lower price. Netflix at $66 against a consensus target of $106 is 42.8% upside to target. That is the widest discount we have tracked. The market is pricing in a worst case that 55 analysts do not support. Our verdict. Netflix is at a valuation top, not an earnings top. The business is not peaking. Revenue is growing. Estimates are stable. No analyst has a sell rating. But the market is repricing what it will pay for that growth. The premium is compressing from 32 times to 20 times. The question is whether 20 is the floor or a waypoint to lower. The actionable framework. Do not buy until the analyst price target dispersion starts falling. Right now, 55 analysts have targets ranging from $70 to $120. That $50 spread means the street cannot agree on what Netflix is worth. The analysts at $70 and the analysts at $120 have not reconciled. Wait for that gap to narrow. When the targets start clustering closer together, it means the street has agreed on the new valuation range. That convergence is your entry signal. Until then, you are stepping into a debate that has not been settled. If the mean drops below $95 with standard deviation still rising, the repricing has further to go. The data says patience, not because Netflix is broken, but because the street has not finished repricing it. When 55 analysts agree on where it should trade, that is when you act. Right now, they disagree by $17 in standard deviation. We will update this analysis when the next consensus snapshot shows either convergence or further divergence. This is Alphatica. We track the data,